So anyway, we're back. That was the whole debt ceiling debacle, but that leads to another problem, which is the debt ceiling. The fact that this Congress, right now, this Republican House, is actually going to be uh, one of the least productive in history, if not the least productive in the history of this country. And how often have we heard that about the Republican House, right? Or Republican Senate? We hear it all the time. But because of that, and because of what's been going on with the Fed and raising Treasury rates and costs of U.S. debt affordability, Moody's, who's one of the three big credit rating agencies, it's S&P 500, Standard & Poor's 500, Fitch's, and Moody's are the three big credit rating agencies. Well, S&P 500 and Fitch have already downgraded U.S. currency. It used to be AAA rated. Now it's just a grade down. Moody's has just said finally they're the last dog to the bowl. Said they're warning that they might downgrade U.S. currency because of all this stuff, and they're going to talk about this on Bloomberg. And I thought this was an interesting take. Oops.
Market reaction to what Moody's published on Friday after markets closed. But does this have an implication for big banks in particular, if not necessarily immediately for financial markets?
Listen, this has definitely been a very slow-moving train wreck, hasn't it, Kaylee? And if you think about it, another downgrade, what would it mean? Of course, they moved the outlook to stable, but another downgrade would be coming on top of other rating agencies that have made similar moves, and it's underpinned by a risk here of just a larger U.S. fiscal situation, which you guys have been talking about. So what does it mean for banks and asset managers? First of all, the initial reaction on Friday was movement in the futures market. A lot of asset managers really buy or short treasuries through the futures market because of the margin required. And remember, the volatility of the asset class would mean that there is more margin required to be posted for the futures contracts in particular. And then in the context of the...
Okay, so just to clarify that for those of you who are uninitiated to this. So margin in investing it's kind of like taking out a marker at a casino, right? You're borrowing money against something else, right? So I have, $10 million in assets, right? And I want to buy another million, but I don't have it in cash. So I take it out on margin as a loan, a short-term loan, against my other investments. They're basically the collateral. And margin is called at the end of every day. So if my investment goes down on the what I bought with margin, right, then I have to pay that amount, that difference, by the end of the day. Otherwise, they freeze my account. So when these guys are doing that, and she's talking about they're taking margin on treasuries and yields and things like that, well, when you up the rates, it becomes more expensive. So they can't invest as much in these futures contracts. And the futures contracts is a big deal because futures refers to goods like corn, grain, beef. Gold, I think, is in there too for some reason. Pork bellies is like a big one, right? And the reason they do that is, look, you're a farmer, right? Let's say hypothetically, Lacey owns a farm and she's making corn, or she's growing corn. Now, if let's say there's a drought or something like that, your crop doesn't yield as much, you could lose a ton of money. You could potentially lose your farm, right? So what you do is you come to me, the broker, the investor, and I make a contract that says, okay, here's what I'll do. We'll buy your corn at this price today, right? And agree to pay you that on a certain date when you deliver the corn, right? For this amount of corn. Well, even if you can't deliver it, you still get that money. And then what I do is I take that contract and I sell a bunch of those contracts and people can bet on it, essentially. And that's how I get the money to do it. Right? But it guarantees that you don't go bankrupt as the farmer. So just because you have a bad year doesn't mean anything. Now, the negative for you is, let's say you have a really good year and it all comes in and it comes in excess and the prices are up. Well, sorry, Lacey, you get the futures contract. I get all the money on top of that. and my investors get all the money on top of that. But you still get your guaranteed amount. So it provides security for a lot of the food industry, the basics of the food industry, right? So it's important to understand that if these guys aren't investing as much in it, now farmers don't have these same kind of guarantees for their contracts. So it does harm production in a downdraft sort of way. And that's what she's talking about right now is from the investor standpoint, it's beginning to be too expensive, too risky.
Mm-hmm.
And
Interesting.
if you downgrade the US dollar, well, it's not worth as much, right? So I can't get as much for my dollar, right? Because the currency valuation will go down, which will cause a little excess inflation on top of that because of the downgrade in currency. So it might be smarter for me to go ahead and just buy it from Mexico or buy it from South America or Africa or somewhere else where it's cheaper.
Mm.
So these things all lead, there's a big downhill effect of that to a downgrade in currency because the value.
So it sounds like it really is quite a ripple effect. Like the ripple really gets felt out quite a lot.
Oh, everywhere, yeah. To everybody in the country, everybody who's trading in U.S. currency.
We start talking about inflation, and what has the Fed been trying to control for how long? That means they've got more work to do because inflation started doing something else for another reason,
right?
And then they have to start futzing with everything again.
Yeah, well, we've been talking about that for months now. It's like the Fed, over a year now, year and a half. The Fed's been doing this, almost 2 years. They've been raising the rates, trying to cool down the economy, and it just won't happen. And the economy's kind of, inflation's kind of cooling down on its own. I would argue that the Fed didn't really have much to do with it. And I think I can make a pretty solid argument that you can't show the Fed had anything to do with it. But unemployment's still really low. So, it is, I mean, it's felt downdraft all over, but if you degrade the currency or downgrade the currency, then the US dollar is worth a little bit less too, which also has that negative effect on the economy.
Basis trade, where you have a lot of asset managers who are buying the spot and shorting futures and looking to really profit off the difference as they converge and lever that trade up yet again with more treasuries and leverage from repo markets. All of this could just make that process more expensive and create risks of whipsawing what is currently a massive trade and being used by levered funds like hedge funds to be buying treasuries up front. So when you're seeing these supply issues hitting the market, when you're watching new treasury issuance, problems like this exacerbate problems like that. And you're seeing the cyclical issue come to the surface at a time when you have many traders really worried that next year would get worse, not just because of these downgrades, but because of this exacerbated fiscal situation you're seeing for the United States, as well as this other big idea here that bank balance sheets are shrinking and facing more regulation.
I mean, what you're talking about.
So, well, let me hear what she said.
It's specifically hitting the U.S. Treasury market. When you look at the reaction of other asset classes, I mean, equities apparently didn't get the memo that something could be up. So what are the wider ripple effects that could come as a result of this?
Now you have to think about it. There's two things here. We're talking about margin being required to be held against the treasury trades in particular. The idea that not only is it going to get expensive because of future regulation potentially coming down the pipe, but also this idea that if you're in a country and you're an issuer in a country, you cannot be rated more highly than the country itself. The one worry that there is underpinning the markets here, besides the treasury market, is to what degree this will start to impact other borrowers, from investment grade to even riskier borrowers, at a time, Danny, where we're seeing more fallen angels. We're seeing more companies fall.
Right. So that's what it's all a downgrade there. So if you downgrade the U.S. currency a little bit, right? So like if we're issuing stocks, right? We're a company issuing stocks, we cannot be a higher rating than the currency, the country that issues the currency we're issuing our stock in. So it affects the value of our stock going forward.
So U.S.-based stock issuances will also automatically end up being well, potentially downgraded. If they were at the highest possible rating, their rating automatically goes down a notch because the entire currency did.
Right.
If they're already not at the top, maybe they won't be affected.
Right.
But the rating of those stocks, that's gotta affect the market, which is gonna affect the prices, which is gonna affect people's retirement, it's gonna affect people's everything.
Right. The value initially goes down a little bit because now our credit is not as good, so now we end up having to pay higher interest on loans or anything we do with our balance sheet beyond that. So it affects it. And it doesn't just affect these companies. They're talking about this on the bigger end, but this goes all the way down to you and me taking a personal loan or car loan or student debt or anything like that. There's going to be an effect on the credit going forward and where that money comes from. And when you talk about treasury rates being so high, that means that affects what banks are loaning out because banks now have to cover more money because the rates are higher. So they can't loan out as much money. So that increases the demand for money because you've shrunk the supply. So now the cost of money has gone up while the value of it's going down because we're getting a credit degrade. Right. So Reuters did an article. I'll just read this little clip from it. So this was Moody's basic. They talked about the U.S. debt and deficits and whatnot, but they mostly talked about this. So the sharp rise in Treasury yields has increased pre-existing pressure on U.S. debt affordability. So it's more expensive, right? Moody's downgrade could exacerbate fiscal concerns, but investors have said they're skeptical it would have a material impact on the U.S. bond market. Probably won't, I agree. Seen as a safe haven because of its depth of liquidity. However, it's a reminder that the clock is ticking and the markets are moving closer and closer to understanding that we could go into another period of drama that could lead ultimately to the government shutting down. And that was a guy, Quincy Crosby, he's a global strategist for LPL Financial, which is the largest brokerage company on the planet.
Right.
And he's making a good point there, which is that part of this is the government shutdown, right? The dysfunction in the government's inability to pay its bills, or the fact that it's always threatening to not pay its bills because the Republicans keep doing the debt ceiling dance. Right, is now led to a degree of uncertainty that's exacerbated by the fact that the cost of debt has risen so high because of the Treasury. So there's a lack of communication here between fiscal policy, which is Congress that sets that, and monetary policy, which is what the Fed sets. Because right now, if you were trying to cool down the economy and hit a soft landing, which is what the Fed wants to do, then the fiscal policy should be, we should pay everything on time and up front. Everything should look cool and calm, and everything should be sweet as a daisy. We should be talking about, okay, how do we get our deficits down? Maybe we should raise taxes a bit on the rich. That's what you'd be talking about from a fiscal standpoint. Instead, they're doing the exact opposite. They're still talking about, let's cut spending, let's cut taxes, let's make things more difficult for the average worker so we collect less in taxes. Making us more unstable as a debt payer.
Yeah, that's not good.
So the whole thing is it's exacerbated itself, right? And a lot of it is just because, once again, you have all this drama from the Republicans in Congress, in the House. They can't get their shit together. And this is what happens when you have a whole party of people that are like, the problem is government, and then you expect them to govern. And then you cause these sorts of problems, right? No, I don't think it's going to lead to a recession necessarily anytime soon. It might, you never know. But it's going to lead to making it difficult for, the average person to afford what they used to be able to afford.
Which keeps being a problem,
Yeah. Yeah.
But it continues the problem instead of makes it, taper off.
Right. And so here's, just real quick, I just pulled this from Trading Economics. So these are the agencies. So Moody's outlook on U.S. currency is negative. DBRS stable under review, but negative watch. Moody's negative. S&P 500 is negative. It's been negative for a long time. Fitch is negative. So that's the outlook. And then there's the do we downgrade the rating from AAA to AA plus or something like that, which would have a negative effect on everybody. So just stuff to be aware of. Did you want to do this cryptocurrency one or?
Yeah, let's do it.
All right. So Sam Bankman-Fried, if you guys don't know, was kind of the big cryptocurrency guy, and he just got hammered for fraud.
Oh man.
Yeah.
What do you do?
Yeah.
What do you do?
Oh, it was massive fraud. So we'll watch a clip of this real quick. But yeah, we'll just go through this real quick. Isn't that it?
Breaking news tonight here in Top Story. Sam Bankman-Fried guilty on all 7 counts of fraud and conspiracy. The 31-year-old was accused of mismanaging customer funds stored in his crypto exchange, FTX, to enrich himself and his family. We're talking about potentially $10 billion in losses. Angela Senadell is back with us. She's obviously one of our legal contributors here. You've been following this case for us. Guilty on all 7 counts. You were following the case throughout this. I mean, it was tough for him to put up a defense.
It was really tough. And frankly, I think it was lost the moment the prosecution turned the 3 lieutenants who were closest to him, especially Caroline Ellison, his former CEO. So it all started there. And that's the reason why I think Sam Bankman-Fried even stood up on the defense stand at all. He had no choice. Everyone said it was him who masterminded the entire operation. He gets up on the stand. He says, it wasn't really me. I'm pretending to be a naive person who didn't know what was happening. But all of the evidence proved otherwise.
Yeah. Just so you know, for the record, my dad's been a criminal defense lawyer for 30 plus years. If the defendant's taking the stand, it's because they've already lost. And they've got nothing left to lose but to try and convince them that they didn't know what was going on. And that's what happened. So it was a desperate attempt. So essentially what happened was this. So he had this cryptocurrency, pushed a lot of it. A lot of people in Hollywood were pushing his crypto shit. It wasn't, it wasn't very safe or secure or anything like that. But plus what he did was he would take money out of that to use it to cover his losses on his hedge fund. So he's literally embezzling money from one company to pay for the other and then trying to desperately pay it back before anybody else finds out.
Awful.
And he ended up losing like $10 billion doing that shit. So yeah, he got hosed. He's going to spend a lot of time in prison. But she nailed it. Basically, yeah, once his staff started to flip, the CEO and all the others started to flip, he's got no defense. Because everybody's saying, yeah, he did it. He knew about it.
Yeah, I mean, at that point, I mean, obviously I haven't looked at all the evidence or whatever, but it kind of seems like, what could you say? What are you going to say? You're right. It has to be sort of a desperate attempt. It's like, well, just throw him up there and like see if he can just like act or something because we got nothing else.
Right. You're moving hundreds of millions of dollars from this place to this place for no reason. And you can't do that because you're taking other people's money to pay for your shit.
Yeah.
It happens a lot in business, but this was pretty blatant, and it was pretty much normal kind of embezzlement kind of thing, right? I use funds from this company to pay for my shit over here. You see it a lot. So you have to always be careful of it. But Speaking of fraudsters, we've got George Santos from New York, House Representative, just got a scathing ethics committee report that found substantial evidence that he broke the law. He's also on several indictments. He's looking at doing time in prison. Oh, yeah.
Oh, man.
But the ethics committee found that he committed fraud, and it's obvious and blatant, and it's funnier than shit. You're going to love this, Lacey. This is a representative from your state
The House Ethics Committee just released its report on indicted Congressman George Santos. And the big headline from this report, as we're still going through it, they say that there is substantial evidence that Santos violated federal laws. Let's get right to NBC's Julie Sirkin now on Capitol Hill for us. Julie, what else are you reading in this report?
Well, look, this is the work of the committee that has been poring over this topic, investigating Santos, and now we have this report just in a couple of minutes ago. They say that Santos blatantly stole from his campaign, spending campaign funds, according to this report, which we are just going through now, on things like Botox, lavish trips to Atlantic City, on OnlyFans, on designer goods. I mean, really everything under the sun. He misappropriated official campaign funds, again, that was supposed to go...
Wait. So, we're talking Botox and porn?
Yep. And lavish trips to Atlantic City. I don't know that I would call a trip to Atlantic City lavish. But...
Well, I mean, maybe the way he was doing it was lavish.
I don't know.
I mean, you don't know how he was,
Yep.
you know?
At the strip club.
I mean, I wouldn't call it lavish, like, you know, in a general sense, but you don't know how he was doing it, so maybe.
But Botox, man.
Botox and porn, like, are you kidding me right now? Are you kidding me?
Yeah, you embezzled money for that shit. It's just hilarious. But this is the guy that also stole money from a homeless vet who needed the money to treat his dog's cancer, remember?
Right.
This is the guy that stole a scarf, like a really expensive Burberry scarf from his roommate, and then he wore it on television at a Stop the Steal rally while he was wearing a stolen scarf. It was...
I mean, like...
And then he went home and he watched that he jerked off some OnlyFans on his, and he paid for it
with embezzled money.
With his embezzled money from his donors.
I mean, while he was at it, he could have at least bought a damn scarf and let his roommate keep his scarf.
Yeah. I don't have a ton else to add to this other. It's just so fucking funny. Oh man.
I mean, I don't even know. It's like it just keeps getting weirder, and his story keeps getting weirder. I feel like it's got to be done now, but I almost half expect 2 to 3 weeks from now we'll be up here and be like, hey, you know what this weirdo is done now? You know? Oh,
you know, sorry, as an ex-cop, I've arrested guys like that where they're career criminals. I mean, you go through their rap sheet and it's a mile long. I mean, it's like every...
You know what? Now, though, I mean, some of these criminals are just idiots, but a number of them are really highly intelligent, and if they would just funnel their intelligence into something like useful and productive, you think about what they could do, you know?
Yeah, I think George Santos is just a sociopath. I don't think it registers to him. I think he knows what he's doing is wrong. Maybe. He knows what he's doing is wrong, and he wants to get away with it, but there's no empathetic nothing going on with this guy. It's, if I can get away with it, it's fine. Right. And now he's all upset because, you know, and he's not going to run again for re-election. Because A, it's so humiliating at this point. And B, he's looking at...
Sometimes people like that. I mean, geez, look at Trump. He thinks his shit don't stink. So, I mean, sometimes people act like that. We're all embarrassed on their behalf, but they're like, what? What was the problem? You know? So, like, nothing surprises me in that arena anymore.
Yeah. Well, they don't like being looked down upon. That's what I mean. Maybe embarrassed was the wrong word. More of, they don't feel guilt about it. They're just upset that they're being made fun of.
Yeah.
But dude, when you're stealing money from your campaign to masturbate on OnlyFans, you're kind of begging for it. But since you brought up Trump,
I mean, it's true.
Yeah, it's true. But since you brought up Trump, we've discussed this before. So Sidney Powell and Janet Ellis, who were previous lawyers, and Kenneth Chesborough all flipped on him a couple weeks ago. And they made deals and pled guilty. And remember, they got great deals. They got misdemeanors, and they didn't get any jail time. They just got probation and some fines, right? And we talked about that. Well, to get a deal like that, because they're looking at serious felonies, right, for the January 6th thing, to get a deal like that, you have to do what's called a proffer agreement, which means you have to go in and basically cough up everything you know before the DA signs the deal. Well, somebody leaked some of the video from the proffer agreement. So we got some of that. We'll show it to you. It was actually one of the defendants, one of Trump's co-defendants. Her lawyer leaked it, and he admitted to it. But and he shouldn't have done that. But this is, at least we get to see some of this. So you can kind of see behind the curtain here what these sort of proffer agreements look like. This is what happens behind closed doors in these kinds of cases. I think it's really fascinating to show people.
Okay.
So this is this is Jenna Ellis, and this is from her proffer agreement. Her basically having to cough up everything she knows.
At the time period where they were going to start to discuss, what was Dan Scavino's role?
At the time, I believe his title was social media director for the White House. It became deputy chief of staff at the time that the conversation in question took place.
Okay, and when was that?
The conversation was around December 19th of 2020 at the White House Christmas party. And I emphasized to him, I thought that the claims and the ability to challenge the election results was essentially over, because he said to me, and I kind of excited to him, well, we don't care and we're not going to leave. And I said, what do you mean? And he said, well, the boss, meaning President Trump, and everyone understood the boss, that's what we all called him. He said the boss is not going to leave under any circumstances. We are just going to stay in power. And I said to him, well, it doesn't quite work that way, you realize. And he said, we don't care.
Okay, so that, we'll get into Sidney Powell's in a second, but that is incredibly damning.
Oh, geez. And terrifying.
Yeah, but it shows intent. They intended to overthrow the election. They intended to overthrow the Democratic election and just stay. And they knew what they were doing was wrong. Now, granted, it's coming from Scavino. It's hearsay about what Trump said. But still, I mean, it's still pretty damning. But it shows you what everybody knows. But now Scavino is really fucked. Because they got him basically saying, we plotted this. And I was a part of it. Now, here's Sidney Powell. She tries to sort of thread the needle here a little bit, where she still wants to be a loyalist kind of thing, but at the same time, she's a nut bar. And we'll go through this because some of this, where she talks about evidence, is just psychotic stuff. But she is out there.
Ms. Powell, were you ever around when anyone told Donald Trump that he had lost the election?
Oh, yeah.
Who?
Pat Cipollone, Eric Hirschman, Derek Lyons all thought he'd lost.
So all of his lawyers are telling him, you lost. So he knew. He can't say he didn't know.
Was that in the December 18th meeting?
Yes.
What was President Trump's reaction when, I guess, this cadre of advisors would say you lost?
It was like, they would say that and then they'd walk out and he'd go, see, this is what I deal with all the time. He was specifically willing to appoint me special counsel. In fact, he looked over at Cipollone 3 different times and said, do I have the authority to name her special counsel? And Cipollone said, yes, you do. And then somebody said, well, she doesn't have a security clearance. So he looked at Cipollone and he said, do I have the authority to give her a security clearance? And Cipollone said, yes, you do. And then about the 3rd time we went through that scenario, Cipollone, I think, said, you can name her anything you want, Mr. President, and nobody's going to pay a bit of attention to it.
So real quick, this is Brian Tyler Cohen that we stole those clips from. But no, the president cannot name a special counsel. That is the attorney general's job. The only time an attorney general couldn't name a special counsel and Congress would have to do it, is if he's the one being investigated or she's the one being investigated. But anything else, the Attorney General appoints special counsel. The reason the president doesn't do it is because you don't want it to be politically biased if you can avoid it. And the Attorney General doesn't have those is not a politician. They're an appointed administrator of the executive branch. Right. So basically they're plotting we're just going to make her a special counsel to go after Biden or whoever just because we can, even though it's not lawful or practical. But this is terrible. So it did cause, Fonnie Willis was worried about, because this was her deal for the RICO case.
Okay.
So she was the one who got these proffer agreements. She was upset because she's afraid that they might try to do a mistrial because this information leaked. It doesn't look like that's going to happen. She did jump on this pretty quick. But the thing about it is now if you're one of the other defendants who hasn't pled guilty yet, you know that they have enough. And right now they're probably sitting with their lawyers and their lawyers are telling them, maybe it's time to cut a deal. I would, after seeing that, if I was representing any of them, I'd be like, now's the time to cut it. You're a small fish. Let's get probation, slap on the wrist, get the fuck out of here.
Right.
Just testify and get the fuck out. But
time to sing like a canary.
Yep. That time has come. The walrus said. Anyway, so that was really damning stuff.
You think they will?
I think we will. I think a lot of times with like these RICO cases where you have this many, once the first domino falls, a lot of them do. And honestly, the DA, she doesn't give a shit about the small fish. She wants Trump. She wants Giuliani. She wants the guys at the top. She doesn't care about the smaller people, right? But it's going to come down to, right now, it's a race to who can get the deal first, because she's going to get to a point where she's got enough that she's going to be like, why should I offer you a deal? What do you have to offer me? Nothing.
What can you give me?
Right. To make me want to cut a deal and go easy on you. So there's that going on. But you see a lot of these RICO trials where like this one, 19 defendants, or you see them with like they have 13 or 14 defendants, and by the end it's 1 or 2 defendants. And everybody else has pled guilty and pled out. And thrown the boss under the bus, which is kind of what they're doing. Which is how these things go. And I bet you that's what happens. I bet you by the time this thing goes to trial sometime next year, probably summer of next year, right? Maybe fall. I bet you it's just Trump and maybe Giuliani and maybe one other person. And everybody else is pled out. I wouldn't be shocked. But yeah.
You know what? I wouldn't be surprised if that happened, actually.
Well, and I wouldn't be surprised if Trump pleads out, because if he gets the January 6th case, the federal case is coming in March. And the judge on that one, Chutkin, she has not broken at all. She's saying, no, we're keeping the trial date. They keep trying to delay. And she keeps saying, fine, you can have an extra week to turn this in or that in, but the trial date stays the same, which I think is March 6th. And that trial, I mean, I've heard different things where it's like, well, some people say it could go 6 to 8 months. A lot of the attorneys I've talked to, they're like, for a trial like that, probably goes maybe 6 to 8 weeks. It's March.
So it's not going to be an OJ, huh?
No, they're like, if it starts in March, the beginning of March, it's over by May, maybe June at the latest. Well, because it's not a murder trial, and there's only one defendant, which is Trump, which was the whole point. This is why Jack Smith they have all the unindicted co-conspirators. He hasn't indicted anybody else because he doesn't want to bog it down. Let's just go right after the big fish, and that's it, and make it quick. Because Jack Smith wants to get a resolution to this, one way or the other, win or lose, before the election. Why? Because the American people need to know about this if they're voting for a president who essentially committed treason.
Right.
We should know that before we vote on it.
There are a lot of things about their lives I don't think we need to know. Treason feels like one we do need to know. Just saying.
Treason's up there. It's up there. It's one of the worst crimes you can commit.
When you speak with, I don't care, treason. Yeah, I care. Mm-hmm.
Yep. Well, I got a special present for both of us, but for you too. So everybody, when we started this show, part of what we started doing was we were like, well, we wanted to go over finance stuff and news and things like that and politics, but we especially wanted to go over the second half of the show, which we always do, is we go over clips from other financial people and we try to break them down, because there's a lot of con artists who are doing the get rich quick, or they're trying to sell you the easy financial plan thing, and it's dangerous.
Or misinformation, right? Yeah. Misinformation, incomplete information. It ranges, but there's a lot in there that can be misleading at least, and
right,
complete lies at worst.
Right. And so when we first started, one guy we stumbled on was Dave Ramsey, and we've done a lot, and we haven't made it real secretive. We think that honestly, I mean, he's not qualified, and most of the advice he gives is really dangerous for the average person. It can be very harmful and cause people to lose, their retirements, lose their homes, things like that. And I've seen it personally as a financial advisor. We didn't realize that Dave had no qualifications when we started doing this. And so we've attacked him a lot. But recently, we're not the only ones. I mean, there are other people that do it, but recently, other financial advisors, CFPs, qualified people who've said nice things about Dave in the past have now jumped on board. So, you there? You back? Oh, there she is. Can you hear me okay? Can you hear me, Lace?
You're kind of cutting out.
All right, let's see. Let's give this.
Yeah, you were cutting out, but you seem like you're back for me now.
Okay, yeah, we just had a little glitch there. But anyway, so we're going to start with this guy. He's got a show called The Power of Zero, and he kind of breaks it down. But then we're going to go to a couple other CFPs, and you're going to be surprised at one of the people I bring up, Lacey. You're gonna love this. So this guy is going to go over.
Okay.
Dave Ramsey. So George Camel does a video. He's one of Dave Ramsey's guys. We call him Skippy. And then Dave Ramsey gets upset about it. So this guy's
in a recent episode
this guy's going to cover it. Sorry.
Of the Dave Ramsey Show, Ramsey eviscerated his co-host George Camel for having promoted sustainable distribution rates in retirement. On his own show, while discussing the FIRE movement, Financial Independence Retire Early, Camel talked about the rate of withdrawal that you could take from your retirement assets and still maintain a high likelihood that your assets would last through life expectancy. Take a listen to what he had to say.
Another flaw with FIRE is that they say you can withdraw 4% of your nest egg, but you'll really need to withdraw closer to 3% if you retire that early. So look at this. If you've saved $1.5 million by your 30s, that amounts to living off $45,000 a year. We're talking about living for 55 years off one account and not depleting it. And if you withdraw 4%, there's a higher chance that money's going to run out well before that time is up. This isn't a wet finger in the air. I don't know why wet fingers are in the air, but they are sometimes. This is just honest math. Literally, there's a site called honestmath.com, and they ran 10,000 different financial simulations to get this chart and show you these numbers. All right, so let's look at this chart. On the left side, we see years in retirement. On the top, we see the withdrawal rate. And as you can see, if you have a 30-year retirement with a 4% withdrawal rate, you're going to have 3% of that account balance remaining 30 years later. That's kind of scary considering you're going to retire at 30. And so a 30-year retirement means at 60, you're flat broke and you still might live another 35 or 40 years.
I'm never going to financially recover from this.
But when we move on to the 3% withdrawal rate, you will see that even 35 years into retirement, if you withdraw 3% a year, you'll still be left with 90% of the account balance. That's pretty impressive. And you can.
Okay, so there's this concept that's...
What rate of return is that chart assuming people are getting?
Well, it's assuming they're using market rates. So
Okay.
I'll show you this because I did a really simplified version just to kind of show you how it works. But they're factoring in a lot of other things that I'm not going to bother with.
Mhm.
Not for this episode.
Okay.
It would take forever. It would be like a 2-hour lecture. So there's this concept out there called financial independence, retire early, FIRE. And the idea is you try to retire by the time you're like 30 or 40. But the idea would be is you have to...
There's not an age to it.
No, not really. But the idea is that the money...
I run in those communities. But yeah, it's the idea of retiring before traditional retirement age.
Right.
Yeah.
The idea is, though, is... So here's the deal. So you got to figure out kind of what you'll need in retirement going forward. Plus what you do is then you go, okay, well, I need X percent of money going forward, right? So typically what you do is when you're talking to somebody who's retiring, how much do you need right now every month out of your retirement account to survive, right? Or every year, whatever it is, right? Let's say I need 80,000 a year, whatever it is. It doesn't matter. Then it's like, okay, then what I do is I go, okay, well, if I'm doing like the 3% rule or whatnot, I divide that number by 3%. That's how much money you need to have saved in order to make this happen. But there's another factor to it that other people forget. And this is where like CFPs jump in and we go, okay, well, wait a minute. When we're doing this, we're factoring in a couple other things. We're factoring in inflation for one, but then, taxes, Social Security, all that other stuff. But just factoring in inflation changes this quite a bit. And I'm going to show you, I did a little PowerPoint for everybody just to sort of show you how this works. And I'm just going to hit a couple key numbers here. Can you see it okay? Okay, so in this scenario, I have a person who has $100,000 saved right here at the top. Oh, sorry, $100,000 saved. And they're taking out 4%. Now, if I'm taking out just 4% of the total account balance going forward, right, which is what Dave Ramsey's going to end up doing here, and I think where he gets confused, and George got a little confused, is so 4% of whatever this total is, right? So 100,000, that would be $4,000. Okay? And then over here on the years, I've got the market returns for the last 20 years from whatever that is, 2003 to today. Okay? So I've got that. Well, the first year I'd take out my 4,000. The second year I'd take out 4% of that growth because it had a good year, 9%. Right? So I got some extra money, so I could take out a little bit more. And the next year I can take out a little more, a little more, a little more. See, good years. Now all of a sudden, boom, here's the 2008 market crash. Now I'm in trouble. Right? Because now I can't take out my 4,000. I can only take out 2,600. And then as the market comes back, I can take it a little bit more, but I'm below my 4,000. And it's not until the market comes back I can take out my 4,000 again and let it sort of build over time. And so by the end, I've grown the money to 168,000, and I'm taking out 7,000, right? This is what I can afford to do. Now, if I were just taking out 4%, 4,000 a month, which is how you normally do this, right? Because it's hard to gauge what your bills are going to be and what your expenses are going to be based on the market. Nobody does that, right? Is that fair or am I off?
No, that's fair.
Right. So most people do it like I need 4,000 a year with what for this. This is just a hypothetical. So if I'm just taking 4,000 a year and I do this, well, if I factor all this in with the withdrawal, that's all fine and I end up making more money, but I collect my 4,000 every year and I end up with more money at the end. If you try to do this with this, hang on. Okay, so if I did that same thing with 8%, and I did it on $1 million, just to be easier. So I'm taking out 80,000 a year. You can see the first year I take out my 80 grand. Second year I take out 80,000. Now I'm going down to take out less and less money. So now I'm really hurting for the rest of my retirement. Taking out 8% of whatever the total is. If I take out 80,000 a year flat going forward, taking out 8% of the total, the $1 million, I run out of money by year 15, by the end of year 15, and now I'm broke. So that's the point that they're getting to, essentially. That was kind of the point. George was getting to the point the fire people were getting to is let's keep it small enough that you can take out that money going forward. But this also changes when I factor in inflation, right? But we're going to watch this because they get into a bit of a scrimmage here, and it's really kind of funny.
You can even see if you go down 45 years, you still have 37% of that account balance remaining 45 years in.
Okay, so George Camel has taken a very prudent, math-based approach to sustainable withdrawal rates in retirement. Whether you want to live a 30-year retirement or you want to retire early and live a 45-year retirement, Camel acknowledges that there are mathematical guardrails that limit how much money you can safely withdraw from your portfolio in a given year and maintain a high likelihood of not running out of money before you die. But there's one huge problem with this video. George Camel's boss, Dave Ramsey, had no idea that he put this video out. And this video is starkly at odds with the outrageously high withdrawal rate assumptions that Ramsey has discussed on his own show for the last 20 years. Let's take a listen to how Dave reacts live and on the air when he learns of Camel's video.
So my question today is I'm baby steps 4, 5, and 6. I have about 120,000 saved for retirement. That's across my IRA, my Roth IRA, my wife's Roth IRA, and the 401k.
How old are you?
And I'm 30 years old.
Good for you. Well done.
Thank you. I feel, from what I've been running the numbers with, that I'm on the teetering edge of coasting financial independence. And I'm trying to best understand my plan with the end in mind. So how I'm going to
What was that? Did you say something?
He hates financial
Independence. Oh, well.
He hates the whole concept of it.
Well,
which is super funny. Like, I mean, my opinion, the only reason he hates that concept is because, like, it doesn't jive with what it is he's trying to sell with his snake oil. You know what I mean?
Right. Yeah, his snake oil doesn't match it, and I'm not saying that financial independence, retire, like, there aren't risks to it, but the math is solid. So I'm not.
It's all based on math. The thing that you could argue is you know what rate you really should be using if you're considering inflation and whatever. Like so there you might want to futz a little bit with it, but it really is based on simple math, but math nonetheless. Which
right.
A lot of the Ramsey stuff isn't.
No, a lot of the Ramsey stuff is just him making it up. It's just gut feeling shit. But
right.
But we're gonna but let's get into his response to George, because George made the argument for it. I guess he was trying to argue against FIRE and say it was flawed. And you can make arguments about that, but it's not. But the math is solid. That's the thing.
Yeah, I guess he kind of did and kind of didn't, right? Like he was kind of trying to say that it was flawed, but at best, all he really did say was, "Yeah, if you're gonna do this, you might need to do it at a lower rate than 4%," which is like, I mean, people within the FIRE community, I loosely would consider myself within the FIRE community, and they don't all necessarily use 4%. There are lots of people that, you know, use percentages lower than that even.
Right. But
anyway, I digress.
But yeah, but we and I'll get into that in a second, because I use 8 and 4. Because Dave thinks 8 is a normal withdrawal, and it's insane. And we'll get into that in a second.
Yeah. At nest egg when I retire into income. I found on your website a little article that talks about 4 to 5% withdrawal rate, and I was trying to run the numbers around that, and I thought I was close. And then about a month ago, George Camel released a video that said that the withdrawal rate for a 30-year time horizon should be closer to 3%. So if I can establish financial independence comfortably, then I was wondering if I could ease up on baby step 4.
So Dave's pissed because this.
Look at his eyebrows and how stuck there, and look at
Rachel.
My favorite.
Rachel's. You know what's going through. I tell you, you know what's going through Rachel's head. The same thing that always is. Da 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 da. Hey. She just
Yeah, well, you can tell. Look at her face. She has no clue what they're talking about because she only knows what her father says.
Yeah.
She doesn't know anything outside of that.
Well, that's where all her money comes from. She knows what cider bread is buttered on.
The house faster.
So here's Dave.
Okay, I'm a little confused because I don't know what the hell George is doing a 3% withdrawal rate, because that's absolutely wrong. I'm gonna have to find out where that video is and get it taken down, because that's just wrong. You don't need to have a 3% withdrawal rate. That's ridiculous. Or I hope you misunderstood. I hope we didn't put out trash like that.
Was it 4 to 5%? Like that?
No, it shouldn't be 4 to 5%. It ought to be more than that. I mean, if you're making 12 in good mutual funds and the S&P is average 11.8, and if inflation for the last 80 years is average 4%, if you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8. So,
so first off, he's done the math wrong. Completely wrong. And he's also assuming you're getting 12% every year like clockwork, which you don't do, which goes back to my graph here where I took the market returns. Some days you have up years, sometimes you have down years.
It's also completely insane that he is fundamentally against the whole fire movement thing.
Yeah.
When really most people in the fire movement are playing it more conservative with their numbers than he is, because they're assuming you could take out 4% or less. I'm aware of plenty of people who keep it under that, even just because they want the buffer, right? And Dave is sitting here saying you could take 8% out, which is totally bonkers. That's high.
Well, because if you
like the them that there's something wrong with them. I mean, like, I'm just saying, like, it's so insanely hypocritical that he would say he's completely against this movement and how crazy it is, but his numbers
are crazy.
Are not nearly as safe as theirs. Like, his are based on some like craziness in his head or something.
Yeah, his are not conservative at all. And there's the first assumption that he makes where he totally fucks this up is you can make 12% a year every year investing in the stock market. Now, a lot of people who are especially older are not going to want to be that aggressive with their money, because if in a down year you really get hurt. But you're assuming you get 12% like clockwork. You don't assume that the market looks like this is what the last 20 years were in returns. Some years are really good and some years are bad. And these are the ones that kill you, right? This was COVID, down 20%, 19.44%. If you're withdrawing money at that time, you're withdrawing it at the low end. You're selling low. And you can't make that money back now because it's not invested. So there's a fundamental misunderstanding of how the market works, or how any investment works, because you're not going to get a clockwork answer that's 12%. It's just not going to happen. The other thing about it is he's doing the inflation shit wrong, but I want to get into this. So this is a CFP named Nikki Dunn, and she's got her own show. And I just want to play the intro to this, but she does a 20-minute video on this whole thing. We're not going to do that long, but because I just want to keep it simple. But she's doing it. Basically, you should never listen to Dave Ramsey for investing advice is the name of this video. Which is funny because we've seen her before and she said, well, Dave's helped a lot of people. He's okay. But she's slowly come around over the last year since we've seen her. So now she's like, no, don't listen to him at all.
And a lot of the studies I found showed...
Well, there's a lot of studies that are stupid in this space.
Hey, Finance Fam, welcome back to my channel. Unfortunately, today there is some Dave Ramsey investing advice that I'm going to have to respond to so that you don't do retirement wrong. Last week, some advice that Dave Ramsey gave on his show about safe withdrawal rates went viral when the professional investing community realized that this advice that he's giving is actually downright borderline dangerous to give. So
oh my gosh, she said it. Dangerous. Have I not been saying that for over a year?
Yes, you have, Duncan. You heard it here on Gossip Finance. Probably first.
You heard it first. I'm going to skip ahead because he does misunderstand this whole thing. But I think did she jump into it? Yeah, she jumps into it right here. We'll cover it right here.
Should be closer to 3%.
So we'll skip ahead on
talking
that.
about is what percentage of our portfolio can we pull out when we start retirement? And then essentially what we do is we take that amount that we pull out in that first year and we adjust it for inflation year after.
And that's what you do first. Dave's doing that last. He's assuming you get 12, you can subtract 4% inflation, so you can take 8. Right? What he's not assuming is that's not per year, because nobody does it by the percentage per year. They do it by the amount they need. So if I need 80,000 a year, like I showed you in this chart here, right? If I need that 80,000 a year, where was it? Yeah. Right? And I'm doing it just with market rates, because Dave's assuming you're all in on the market because you got to be getting 12%. I'm out of money now at year 15, and I didn't even factor in inflation. Right? So here, let me go to this, and I'll fix this real quick. Oops. But no, I mean, that's the thing. So he did this, and then, of course, all the financial people had to pile on. Because this is extremely dangerous. Because if you start taking out 8 thinking that's safe, you're going to be gone. You're going to be out of money and in deep shit. That's why this is so dangerous. And that's why Nikki Dunn there was pointing that out, that this is really dangerous. So here's 8% inflation adjusted. Right? So I didn't adjust Dave's assumption here. So in Dave's assumption, by year 20, you can only afford to take out $60,000. When really in year 20, if you adjust for inflation, you would need $175,000 to maintain an equal spending amount as $80,000 that you started with on your 8% withdrawal. And if you look at this, the numbers get negative here on the right. They get negative here at year 11. So by year 11, you're broke under Dave's math, under his plan there. That's why this is so dangerous. Extremely dangerous. Now you're retiring at whatever age, it doesn't matter, but now you're broke. And you're starting over from scratch because you listen to Dave Ramsey. That's why this is so dangerous. And she points out just that adjusting for inflation fucks him. Because he's not adjusting for inflation every year over year. And is assuming a flat rate of return. So the whole thing's saying, well, watch a little bit more of Dave, and then it's just kind of crazy. But we've been saying this for a long time. People that listen to him, he doesn't understand what he's talking about. He's not qualified. And if you listen to him, there's a good chance you get fucked over.
Comfortable drawing 8. But if you want to be a little bit conservative, 7, but sure not 5 or 3.
Well, I was trying to back check it because, 3 to 5, I thought that was a big range. And a lot of the studies I found showed...
Well, there's a lot of studies that are stupid in this space. It's just wrong. Listen, man, the math I just gave you is the math. If you're making 12% and inflation is 4, and you leave 4 in there, so your nest egg grows by 4, it's simple. 8 is what's left over. So if you got $1 million and you leave 4% in there, that's $40,000. Okay, so you now have $1,040,000. So
what was that?
He's literally the only person in the world that thinks that he's getting 12% every year.
No.
You might make more than 12% some year. You might get less than 12%. Like, you are not literally getting 12% every year.
No.
And he says he's gotten at least 12% every year since the beginning of time when dinosaurs roamed the earth.
Which is bullshit. No, it's a lie.
Are you kidding?
No, it's a total lie. But here, let me fix this. But yeah, no, I mean, that's the problem. And so, I mean, I think Nikki did a good job of just pointing out that, hey, I mean, he doesn't really know what he's talking about. Because if he did, he would know that that's just insane what he's proposing.
Well, and look at how he handles a caller that actually read studies. He's like, "Well, I was reading some studies," and Dave's like, "Studies? Well, like everybody's got a study." Says the man who says that his millionaire study is anything other than a damn survey. You know, like,
and it's total bullshit too. The conclusions they draw.
and any of the studies or articles they read, they haven't even read because we pulled half of them up on here,
Right.
and they don't actually half the time say whatever it is Ramsey pretends they're saying.
Right. So here, let me show you this. So here's 4%. This is why the 4% number, it generally works. So here it is, inflation adjusted, right? So I didn't adjust it if you just took 4% of the account per year, right? It would still grow in the end because you're not dipping into the principal. Shit, what's going on? Okay, right there. So by the end, you'd be taking 70,000 a year out, right? This is assuming 4% from 40,000, right? Initially, so you'd be able to take 70, but what you really need is 87. So you're not ever meeting your need. But if you take the 4%, account for inflation with a market investment, you'd be fine, and you'd still have 990 something thousand left.
Right.
And you'd still be getting your 40,000 a year. That's what George Camel was talking about. Generally, I'm just doing 20 years. They were doing 30 years. Right.
Sure, but the point is, it's not running you out of money, which is, and God, I can't believe I'm going to even in a sideways way be agreeing with Skippy, but like that was kind of the point Skippy was making, was like playing it safe enough not to be running yourself out of money.
Right.
It was like the whole point.
Right, but you got to remember too, he was trying to do that to downplay it and say it's a stupid idea.
Yeah, I don't know if he knew exactly what he was doing, but the point he thinks he was making is not the point he made. The point he actually made didn't suck, but I don't even know if he knew he was making it. But that's another issue altogether.
Well, his argument was if we do the FIRE method, right, you'd have to take out 3% to be safe. That was the downfall of the FIRE method. You can't take out 4, you can only take out 3. And it's like, yeah, okay, whatever.
But you're also kind of splitting hairs there at that point too, like,
right.
Okay.
So he's trying,
assuming every single person in FIRE was doing 4,
right?
And they're not.
So he's trying to kiss Dave's ass by saying FIRE is stupid. The financial independence retire early thing is stupid. But like you said, he's just splitting hairs, and it's all stupid and bogus. What ends up happening though is people listen to that and go, okay, well, 3%, that makes sense, right? Because what he ends up doing is defending it accidentally. And then Dave hears this, and Dave's like, what and then Dave's like, well, why is he spewing that bullshit? Well, actually, he's trying to defend you, Dave. He just did it he just did what he always does, which is he's trying to make this point and ends up defeating himself in his argument, and then he just sticks with it anyway. Right? Because as we've talked about many times, their whole thing is no matter how much the evidence changes, the conclusion has to remain the same with Dave Ramsey. And that's science. That's just math. But that's the point, is it's so stupid. And then Dave goes off on this rant, and then what does he do? He pisses off the whole financial community. The actual financial community, those of us that actually have degrees and do this for a living. Because Nikki Dunn is a certified financial planner. She's not like some half-ass. She's got to practice. She knows what she's doing. She does this for clients. Right? You know who else, who was a big defender of Dave's that we used to make fun of? Also a CFP with a big practice.
Oh, you didn't.
Yep, he did. He did.
Oh.
Here it is for your viewing.
Oh.
Let's see.
Oh, please give me the pleasure.
Oh wait, hang on, Lee. So this is Dave. Where's the volume here?
Above his head.
Oh, is it?
Put your little cursor above his head.
Got
Yep.
it. There we go.
Create for you an $80,000 income, boys and girls, perpetually, forever. The problem is when you go down these stupid nerd rabbit holes in these Reddit threads with these morons who live in their mother's basement with a calculator.
Dave has lost the plot. If you rely on an 8% safe withdrawal rate, as Dave says, it only has a success rate that's less than 40%. Is that what you want to build your financial future off of? I care about you. I want to make sure you don't get led astray. Sequence of return risk is real. And there's a better way to do money. That's why next week we're going to premiere.
I'm going to forget his plug, but.
Okay, so hold on here. So I got to say, I am laughing my butt off at what that guy just did. The money guys. So the money guys have spent all this time kissing Ramsey ass to try to get a slice of their conservative pie. Being in the South, et cetera, et cetera.
Yeah.
And now they see a screw up that's big enough and being nailed by other people in financial community, that actually have designations, etc. That their move is, okay, now we can cut ties so we don't get associated with something that's dead wrong. And if we've already got some of their viewership, that maybe if this thing gets big enough, we can zoom in and take over their viewership.
Right. Well, I think also their bigger thing is, I think they thought, okay, we got whatever we're going to get has been gotten, right? And Dave's not going to share. He's not going to tout us to his audience or anything like that unless we pay him millions of dollars, which we're not going to do, right? But they've kissed, you're right, they kissed his ass. They told him how he was great. He's helped so many millions of people, and he's just wonderful, blah, 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 which is total bullshit. He hasn't helped millions of people. I would argue he hasn't helped anybody. And I'll make that argument, and you guys want to come on the show and make that argument with me, I will make that argument any day of the week and prove it. Right? But the bottom line is, now all of a sudden, that relationship didn't work out for them, and Dave does a big, obvious fuck up like this, which is really dangerous, where a lot of people could get hurt by listening to him. Now they have to throw him under the bus. And he does it with gusto.
Little bus check.
Right. Nikki Dunn jumped in and did it with gusto. But she initially started out with, well, I guess Dave's not so bad. I guess he's helped people. And then she's going like, wait a minute. He's selling this product that's bullshit, and this mortgage product that's bullshit, and this thing. And she's come around quick to like, no, this is all. You scratch the surface and you realize the guy's a fraud. That's why he lives in such a tight bubble where it's just his own crew and nobody debates him, and he doesn't bring on any dissenting opinion.
And he hires all people with no financial background at all. And then he's like, well, I'm going to teach you everything you need to know about finance. And so these folks have no idea that what they're being taught isn't finance, like very little of it has anything to do with actual financial anything,
right. And if any of them challenge him or anything, they're gone. He fires them and tries to bury him. Because he has to, because any little...
Yeah, look at Chris Hogan, man.
Yeah, anybody even looks at him with any sort of depth. Not even a lot. Just, like I said, just a scratch surf. Yeah.
He got rid of Chris Hogan, and then he rewrote basically the same book as Chris Hogan's book.
And took credit
slapped his own name on it, a different title, because it's a different book, but basically the same information, just so he could bury Chris Hogan.
Yep. I'll bet you the same thing happened to, what was the other guy, Anthony O'Neill, who I don't like, but he got buried too. But that's the whole thing, is so he's going off, but that's the thing, when a financial advisor... Well, Dave's not an advisor. He claims to be a financial expert. But anybody who claims to be a financial expert or advisor or anything like that says don't pay attention to the math, they're full of shit. If they say, well, if you go down these nerd rabbit holes...
Everybody's got a study. Like, are you kidding me?
Yeah, but some are actually peer-reviewed studies, unlike Dave's bullshit that he hawks. You can pretty much rely on a peer-reviewed study. They're not 100%, but you can rely on it. Is at least fairly accurate. But anyway, yeah. So it's just, it's nice to be vindicated. We've been pushing this for a year, that this guy is dangerous and you shouldn't be listening to him. And now it looks like the rest of these certified financial planners have jumped on board and said, yeah, fuck this guy.
Oh my God.
It's so nice to be vindicated. And I'm sure it's because they watch our show every week, and now they're like, yeah, Duncan and Lacey were right. We should have. Yeah, clearly that's what's going on. Yeah, I wish. Well,
That
anyway,
would be pretty great.
That was our show for today. Thanks everybody for watching. Where can everybody catch you, Lacey?
All right. As always, you can find me at mysensewithsense.com for information about workshops, articles I've written, course information. If you have questions or comments about any of those, you're welcome to email us. And hey, while you're at it, send us some more clips. We dig those ones you've been sending us, or invite yourself on the show.
Yep.
The invitation is still out there. Duncan, where can they email us?
You can email us at gossipfinancead@outlook.com. And thanks everybody for watching, and we will catch you next time. Happy Thanksgiving to everybody out there.